For decades, gold has been considered one of the safest assets for preserving wealth, while Bitcoin has emerged over the last 15 years as one of the most revolutionary financial innovations in modern history. Both assets have passionate supporters, impressive long-term performance, and unique characteristics that attract investors from around the world. Gold has survived thousands of years of economic cycles, wars, inflation, and financial crises, earning its reputation as a trusted store of value. Bitcoin, on the other hand, has introduced a decentralized digital monetary system with a fixed supply, offering investors an entirely new way to store and transfer value. As we move closer to 2030, one question continues to dominate financial discussions. Which investment has the greater potential to make investors richer, Bitcoin or gold? The answer is not as simple as choosing one over the other. Both assets serve different purposes, respond differently to economic conditions, and involve different levels of risk. While no one can accurately predict future market performance, understanding the strengths, weaknesses, opportunities, and risks of each investment can help investors make more informed decisions. In this video, we will compare Bitcoin and gold across multiple factors to better understand which may offer greater wealth-building potential by the end of this decade. Today, we will talk about Bitcoin versus gold, which will make you richer by 2030. So, before we start, make sure to hit the like button and subscribe to my channel. Understanding gold's long history. Gold has been used as a store of value for thousands of years. Ancient civilizations used it as money, governments built monetary systems around it, and central banks continue holding large gold reserves today. One reason gold has remained valuable for so long is its rarity. It cannot be printed by governments, and its supply grows only gradually through mining. Investors often purchase gold during periods of inflation, economic uncertainty, geopolitical conflict, or financial market stress, because it has historically preserved purchasing power over long periods. Understanding Bitcoin's digital revolution. Bitcoin was introduced in 2009 as the world's first decentralized cryptocurrency. Unlike traditional currencies controlled by central banks, Bitcoin operates on a blockchain maintained by thousands of computers worldwide. Its supply is permanently limited to 21 million coins, making it one of the scarcest financial assets ever created. Supporters often refer to Bitcoin as digital gold, because its limited supply and decentralized structure provide characteristics similar to precious metals, while offering the advantages of digital technology. Scarcity creates long-term value. Both Bitcoin and gold derive much of their value from scarcity. Gold requires expensive mining operations, and new discoveries become increasingly difficult over time. Bitcoin's scarcity is even more predictable, because its maximum supply is permanently programmed into its code. While additional gold can still be mined, no more than 21 million Bitcoins will ever exist. Many investors believe this limited supply could support long-term price appreciation if demand continues increasing. Historical performance comparison. When comparing historical returns, Bitcoin has significantly outperformed gold since its creation. Early Bitcoin investors experienced extraordinary gains as adoption expanded worldwide. Gold, meanwhile, has generally produced steadier but more moderate returns over long periods. However, historical performance does not guarantee future results. Bitcoin's rapid growth occurred while it was still developing as a new asset class, whereas gold has already been widely accepted for centuries. Future returns for both assets may differ substantially from past performance. Volatility is one of the biggest differences. Perhaps the most obvious difference between Bitcoin and gold is volatility. Bitcoin regularly experiences large price swings that can exceed 20 or 30% within relatively short periods. Gold prices also fluctuate, but generally move much more gradually. Investors seeking maximum growth potential may appreciate Bitcoin's volatility, while those prioritizing stability often prefer gold. Higher potential returns frequently come with higher investment risk. Inflation protection. Both Bitcoin and gold are often viewed as potential hedges against inflation. Gold has demonstrated this characteristic over many decades by helping preserve purchasing power during periods of rising prices. Bitcoin supporters argue that its fixed supply makes it resistant to inflation, because governments cannot create additional coins. Although Bitcoin's inflation protection history is much shorter than gold's, many investors increasingly consider it part of their long-term strategy for preserving wealth. Institutional adoption is growing. Institutional investment has become increasingly important for both assets. Central banks continue purchasing gold as part of their national reserves, reinforcing its long-standing role in the global financial system. Bitcoin has also gained institutional acceptance through investment funds, publicly traded companies, asset managers, and exchange-traded products. As institutional participation expands, both assets may benefit from increased demand and greater market maturity. Accessibility and convenience. Bitcoin offers advantages in terms of digital accessibility. Investors can purchase, transfer, and store Bitcoin electronically, allowing transactions to occur across borders within minutes. Gold, while tangible and universally recognized, often requires secure storage, insurance, and transportation. However, many investors appreciate gold's physical nature because it does not rely on digital systems or internet access. Economic uncertainty benefits both assets. Periods of financial instability often increase interest in both Bitcoin and gold, although for different reasons. Gold has historically served as a traditional safe haven asset during recessions, banking crises, and geopolitical conflicts. Bitcoin is increasingly viewed by some investors as an alternative financial system, operating independently of central banks. While their price movements do not always align, both assets often attract attention when confidence in traditional financial markets weakens. Government regulation could shape the future. Government policies will likely influence both investments before 2030. Gold operates within well-established legal frameworks and has been traded globally for centuries. Bitcoin, however, continues evolving within changing regulatory environments. Supportive regulations could encourage wider adoption, while restrictive policies might create temporary uncertainty. Investors should recognize that regulation remains one of the key factors affecting cryptocurrency markets. Supply and demand dynamics. Gold supply depends on mining production, recycling, and exploration. Although supply increases slowly, new discoveries remain possible. Bitcoin follows a completely transparent issuance schedule controlled by its programming. Approximately every 4 years, Bitcoin undergoes a halving event that reduces the creation of new coins entering circulation. This predictable reduction in supply has historically contributed to periods of increased investor interest, although future outcomes cannot be guaranteed. Portfolio diversification. Many experienced investors choose not to view Bitcoin and gold as competing investments, but rather as complementary assets within diversified portfolios. Because each responds differently to changing economic conditions, holding both may provide broader exposure while reducing dependence on any single investment. Diversification remains one of the most effective strategies for managing long-term investment risk. If you liked this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.